So Mark Lackey is here, Executive Vice President at CHF Capital Markets, and I kind of was joshing you a little bit because the oil prices are going my way and the gold prices are going my way.
Well, we're
focusing on oil.
We're going to talk gold in a couple of weeks, probably,
okay.
Pat. So that the viewers know. But you know, my oil range in the last couple of years, Pat's been 90 on the low end, 110 on the high end. And why do I have that? Because there are seasonal factors in oil. And if you've gone back the last few years, when have we seen oil the weakest? Generally August, September, October. So I'm not surprised the price is here. In fact, the last time I was
on... That's still the driving season. That's when real demand from North America
the driving season, though, Pat, the inventory buildup is really big. Because I was in the oil business. We still do have some driving, but the fact is the inventory buildup is really through up until about July. And then you start to destock somewhat because that's the way they operate, particularly the U.S. refineries. You'll note that oil inventories in the U.S. are a bit higher right now. That's not the same in China and India. And I mean, that's a whole other issue that we can discuss here on the demand and some of the supply issues. But I do believe, Pat, that in the last few years, it's been very consistent that we traded down as low as 88 last year, and then we bounced back up into the 100 range by the time we're in November. So unless people expect that we're going to get a much weaker world outlook for some reason here in the next 3 months, I would anticipate we will recover again, at least back into the upper 90s.
Yeah, so you're sticking with your range.
Absolutely. I mean, it's been right for the last couple of years. And as you know, Pat, there are some people out there now that are saying $75 oil, 75 to 80, particularly some of the U.S. Bankers, and it's going to stay there for 2 or 3 years. And I have some demand and supply reasons why I don't agree with that scenario.
Okay, start with the demand side.
I think the first thing, Pat, too many people concentrate only on the United States, and that's fine. It is still the biggest market in the world. But as we've pointed out before, China is now up to 20 million cars a year. That's actually 4 million more producing than North America at 16. And we expect they're going to be up to 22 million next year. So you're getting this increasing demand for gasoline from China that, you know, that oil has to come from elsewhere in the world. Secondly, India, with the new government and the new prime minister, we're seeing auto sales up about 16% year over year. So there's been a move here in India to higher gasoline demand as well. And I really believe India, with this new government, is going to see higher consumption consistently, because he's cutting taxes, he's cutting government red tape, he's trying to move to more of a market system in India. And I would actually step out and say I think India is going to be the next China down the road in terms of significant growth. So I think on the demand side, Pat, and the other point in the United States, I mean, the gasoline demand is back to an all-time high. Yes, it took 7 years to get back to 2007 levels, but we are still growing in the United States. I think that's a point that people should remember.
Okay. On the flip side of things, supply. There's lots of oil in the States, and they're finding more.
You're right that we are seeing quite a bit coming out of Bakken and the shale area. But, you know, let's take a look quickly at some costs. We all know Saudi Arabia pulls it out of the ground at 15 bucks onshore, Russia 20. But when you go to some of the high cost areas, and in fact some of the American areas are quite high cost, some of that shale oil is $80 US. So if you get down to say even 85, some of these guys are going to shut some of it in because they're not going to make a small profit. So, and some of the North Sea oil, Pat, is $95 oil. And it was 105 recently, and both Norway and Britain cut taxes, but they can only cut these taxes so far. So I think that when you start looking, and some of the oil sands, Pat, is over 80 as well. So I do think there's a certain number of marginal barrels that if you go down much below $90, they'll come out of the market. Well, you take supply out of the market, Pat, and your demand is still relatively good, your price comes back up. So I think it's somewhat of a self-correcting mechanism sitting there that would prevent a $75 or $80 oil. It could happen for a short time period, Pat, in a seasonally weak time, but I don't think it remains there.
I never trust those numbers, though, production numbers, because I remember $10 oil and everybody was making a fortune, even at those prices.
Yeah, you know, Pat, I know what you're saying, and in the old days of OPEC control and a lot less transparency, because don't forget I worked in the oil business for 10 years back in the 80s, but today I think a lot more information is out there and it's more transparent. There's more people, like, for instance, the Big Seven, when I was working, controlled most of the world production. It's not true today. I mean, there's a lot of small and mid-sized guys that are out there producing oil. So I think there's a lot more transparency on these numbers.
Okay, so your picks then include Canadian Overseas Petroleum.
Right. Now, I like this play, Pat, because they're off the west coast of West Africa, or sorry, off the coast of West Africa. And so offshore West Africa has always been a place I've been fascinated with because it's been under-drilled. And in the last 5 years, that's changed. The majors have gone in there, found some pretty good oil. This deal that these guys have is they own 17% of this property, and Exxon owns 83%. Ooh. So they've got the biggest player in the world. And the other reason I was drawn to this company, and the reason Exxon would have been, is that the management team was successful in the North Sea. Why is that important? The geology offshore Africa basically is most similar to the North Sea. So they've had experience doing the geology and doing drilling in areas that are complementary to what you have, say, offshore Nigeria, offshore Gabon. And that's important because if you're working, say, Texas or those places, the geology is completely different. Mm-hmm. So we have a company here, Pat, that's moving forward. They just raised, I think, around $10 million. If you can raise that kind of money in this market, I mean, that tells me that certainly the market players and the people on the street are believers, because it's still tough to raise money out there if you're a junior company.
Yeah, I'm surprised they only raised $10 million, though, given that they're 17% and 83% is Exxon. I mean, is this a potential takeover?
Well, you know, one never knows. I mean, that's, you know, I think initially Exxon likes to have certain selected partners that they believe in, and they'll do some of the work along with them, and then you see where it goes and where it takes them. And certainly I'm sure that if enough is found here, then they could certainly be a definite takeover candidate. It's a little bit early at this stage, but you're right, Pat. I'm sure that when Exxon does some of these joint deals, that's always in the back of their mind.
Yeah, I figure. Emerald Bay Energy is the next one.
Right, and we had mentioned this once before, Pat. They just also were able to complete a financing. So again, you can see my theme on these two companies is that I went to people who could raise money in what I still think is a pretty tough market. And if you can raise the money, Pat, that tells me that the capital markets people and other brokers and other people out there are clearly following these plays, and they're willing to step forward and put money in there. And they have land in Texas that a number of years ago wouldn't have interested us, but of course with all the improvements in fracking and bi-directional drilling, you know, I think they're sitting on some property now. Now that they're raising the money, they can go do the work. I think it's highly prospective.
Are they on pre-worked land?
Yeah, there's land there, Pat, that has had work before. But of course, the problem for a lot of it was that if you worked the old technologies and techniques, you knew the oil was there. I mean, we knew that when I was at Gulf and various places, but we couldn't get it out. But now, with all the changing technology, especially on the shale side, and as I said, the fracking side, now this land becomes quite valuable, because it's that whole Eagleford, that whole area is what's been one of the big new areas, not only in the United States, but Pemex is going to start opening up a very similar area on the other side of the border, for example. So I think there's a really good opportunity for Emerald Bay now. I mean, its time has now come.
Okay, are they actually pulling out of the ground now?
No, they will be very soon, though. Now that they've raised the money, the next step will be to go to production.
Okay, and then the last one, a little bit different theme, Bri-Chem. We've talked about Bri-Chem.
Yeah, we've talked about Bri-Chem, Pat. And what changed there was that at one point they were a liquids player and they produced steel pipe. They sold the steel pipe partly because they had a good offer for it, and they also recognized that they concentrated solely on the liquids business, that it would give them more leverage. And so the liquids business is growing dramatically. Again, given the changing technologies that are out there, whether it's shale or all the type of fracking that's done, you need liquids. So they were smart because they'd acquired a number of people over the last few years when that business wasn't as strong. And now it's starting to take off. And I like its opportunity. I mean, when we mentioned it last time, Pat, I mean, the stock's up about 15%. But I would argue that's, you know, that's not that big a move given where I think this company can go here in the next year or two.
Where is it physically located, Bri-Chem? Or does that make a difference?
Well, they have operations. Their head office is out in Edmonton, but they have major operations in the United States. Okay, I would say that, you know, their biggest, they've got business opportunities all through the United States. They're big in Texas, for example, and they're big in some of the other shale areas.
But there's not an issue of transportation of liquids to address per se.
No, I mean, they basically, Pat, I mean, that's very simple, and they bought so many people that the smart move they made was that they've got, you know, more than a couple of plants. So that gives them the geographical advantage over maybe somebody who's simply in, say, the Bakken, for example.
Yeah, that's why I asked about the geography.
Yep.
And Mark, I'm going to be away a couple of days next week. Do you want to come in a day early, maybe next Monday?
Sure, Monday would be fine. Yep.
Look forward to seeing you.
Okay, that's great, Pat.
Mark Lackey, Executive Vice President at CHF Capital Markets. Coming up, though, Ontario Lottery. Is it for sale, and who might buy it?